What's going on, guys? I just wanted to come and talk to you guys today about how to know when to cut your losses in the stock market, and how do you decide when is the right time to do that. Realizing a capital loss before it gets out of hand is what separates, successful investors from the rest. And how we, deal with these type of situations is by having a written out plan of, when we're deciding to cut losses if losses do get out of hand. So we need to have a written plan for each of our investments on what number or what price number or what percentage loss is going to be the number that we use to justify getting rid of that stock. This can be a little tricky because it's really subjective. If my stock is going down, first of all, I invest in companies that I have the utmost faith in, that I believe are going to be vital in the future, or are not necessarily a necessity, but they're strong enough that they're going to be able to withstand any type of bearish market or any type of recession or depression or anything like that. So me personally, I don't necessarily look to cut my losses. If I do cut my losses, it's specifically for tax reasons. To have a specific loss for tax reasons so I don't get taxed as much. But other than that, I really look to hold my stocks. I look to hold my companies, and if I do see a dip in the market, or if I do see a real landslide of the value of my stock going down, I look to buy more. I buy on dips, so I wouldn't necessarily look to sell. Granted, not everybody thinks the way I think, so you could be looking to sell before your break-even number, just to take away a little bit of profit because you believe it's going to drop below your break-even or your initial investment. So you may be looking to at least get 10% of that profit. So that means you should have some type of stop order put in place. So if the stock reaches a certain number, it's going to trigger the market to sell your shares. So you can mitigate your losses that way, or have a trailing stop loss order, which is pretty much the same, except it's percentage wise, and it follows the stock up. So if a stock is continuing to rise, that trailing stop order follows that stock. But if that stock ever dips below whatever your percentage is, say you put a trailing stop order at 10%, once that stock drops down 10%, it's gonna trigger the market to sell your stock, your shares. So I do like using trailing stop orders when I am swing trading. When I do swing trade, I don't swing trade much, but if I am swing trading, I like to use a trailing stop order because, I'm riding that company up for the few days. And once I start to see somewhat of a pullback of, usually I do mine at 10% or maybe 15, then, I'm triggering the market to sell my shares so I can get my profits and then put that money back into my long-term companies. So some people may operate that way. I don't operate that way on my long-term investments though. So if those prices continue to drop, I continue to hold and just buy more and make my position even larger, because in the long run, I believe that that stock is going to go back up. So I have faith in the companies that I have invested in for the long term. So this goes in line with the companies that you invest in. Do you really believe in the companies that you invest in? Do you have faith that those companies can make it through the situation that you may be currently in? And I feel like if you don't have that strong of a conviction on the company that you're holding, let's say for long term, then I don't think you should really be in that play. You need to put your money into companies that you believe are strong and are going to be able to grow your money in the long run despite any type of fluctuations or hiccups that you may come across in the market. Because when I'm looking to invest in growing companies, and I'm looking to hold. hold means hold. It doesn't mean hold when we're only in when we're in a bull market, but it means holding when we're also in a bear market. It's holding through all of that, and hopefully I can see the returns pay off from me being strong enough to hold when times got rough. And it isn't for the weak. The stock market isn't for the weak, because you have to realize you don't have a loss in a particular company until you sell. Then it's a realized loss. If you're down in a particular stock in your portfolio, it's only a paper loss. Then it's not realized yet. It's not realized until you actually sell it. Same way for profits. If you're up in a particular stock, it isn't realized until you actually sell it. Then it becomes, a capital gain. But if you're down in it, it isn't realized. You haven't really lost anything yet. So most people panic. And this is why so many people don't last in the stock market for years, because they panic and they sell. They hate seeing those red days. And when those red days come, they freak out, and they allow other people to freak them out because they're freaking out. And you feel like if they're freaking out, I should be freaking out. So I need to pull my money out. So that's time. I look at that as time for me to buy. When people are scared, that's when you should be buying. When people are buying, that's when you should be holding and not selling or not buying anything. That's because, the market's in a bull run. So when people are scared, you buy. And when they're not scared and when they're bullish, you hold. And you wait for those pullbacks, because pullbacks will happen. So, when it comes to selling, it's all based off of preference. It also has to do with the price that you got in. If I got in at, $23 and the stock was at 24, the next day, and then all of a sudden it drops down to $19, I'm not really panicking. I know that's just the fluctuation of the stock market. It's going to be up and down days. Now I'm really starting to look at the stock. If it's down, 20%, then I'm looking to see have the fundamentals changed of the company. That's the only time I may look to sell a stock, is if I believe the fundamentals have changed. Either they got a new CEO who can't really lead the company. He's not, a great fit for the company, or the company has new competition that's looking to wipe them out. The competition is selling a better product. The company, maybe the company's sales are down, the revenues are down drastically, because, a company may have revenues that may be down because of, whatever's going on, because of C-19, because of a pandemic, revenue may be down, but it's just justifiable. I understand why revenue's down in that sense. But if it's majorly down for no reason, then I'm looking at that company, and then I'm deciding on whether I want to continue holding my money in it, because the fundamentals have changed. Now, if the company's fundamentals haven't changed and the stock price just drops drastically, or it drops a little bit, I'm not too worried, because I feel comfortable in the company. Nothing has changed. They're still hitting their sales. They're still making their profits. Profit margins could be even, getting bigger, and the company may be going down from a stock price, down in stock price. So, my decision on selling is based off of the fundamentals. If something has changed within the company that is causing its stock price to come down. But if it's just off of hysteria and people being scared and people, it's a bearish market, then I'm holding. And if I'm doing anything, I'm buying more. So that's how I suggest, most people to operate. That's how I would want you guys to operate. If you want to sell because you just want to pull your money out and you feel that your money can go somewhere else where, you can recoup on those losses, then do that. I've done that before. I've gotten out of companies because I believed I had more conviction in another company, and I knew that company would pump my money a little bit and recoup those losses that I just had. So you can do that, but typically in the companies I really believe in, like if I was to say Apple, or if I was to say Microsoft, or I was to say Tesla, I'm not selling. I'm just buying more on those dips. I'm not selling with those kind of companies. Those are blue chip companies that I wholeheartedly believe in. So it's coming down to you understanding what companies do you have the most faith in, what companies are your favorite, and what companies are you looking to hold in the long term, because those companies you shouldn't think about selling. You should only be thinking about opportunities where you can buy more. Those other companies that you may be swing trading, those companies, you can mess around a little bit with. You can pull your money out and, maybe put it somewhere else where you feel like it's going to pump a little bit, maybe for a couple weeks or for a couple months, and then take those profits and then throw it back into the companies that you are holding for the long term. So that's what I do. If I do swing trade, I'm only doing it really to feed my long-term investments. I may put some money into this company, let it give me, 20% in returns, and then that extra profit I throw back into Tesla, or I throw back into Apple. I continue to feed and continue to buy more shares of my long-term investments, of the ones that are my blue chips that I believe are going to really give me gains in the future. And that's how you build out your position within, those companies and within your portfolio. But yeah, that's all I really had for you guys today. I might be coming with a few more stock videos. I just been getting a ton of DMs from people asking me about what market should they invest in, what companies should they look at, what companies that I'm looking at. So I just wanted to make a few videos that would hopefully answer some of those questions that people may be having, to help them out, because most of my learning came from other people and from books. So if I can pass on any knowledge, I'm willing to do that. So I thank you guys for joining me today, and I hope you enjoy the rest of your day, your month, and your year. And I'll catch you guys in the next one. I'm out.